Warren Buffett's most iconic interview ever. The Oracle of Omaha, as he has come to be called, has guided his company's Class A shares, BRK.A, to an astounding average annual return of 20.1% in the 57 years since taking the helm. As of June 2022, his net worth was estimated to be $100 billion. Warren Buffett is most well known for being one of the most successful investors in the world. Because of this, it is not unexpected that Warren Buffett's investment approach has grown legendary in scope. In this video, we will see the keys to his success and learn more about Buffett's approach to how his investments have allowed him to acquire such wealth. In 1930, Warren Buffett was born in Omaha. At a young age, he became interested in business and investment, including in the stock market. Buffett began his studies at the University of Pennsylvania's Wharton School before returning home to attend the University of Nebraska, where he earned a bachelor's degree in business administration. The Columbia Business School is where Buffett later attended and received his doctorate in economics. Early in the 1950s, Buffett started his career as a salesman of investments, but in 1956, he founded Buffett Associates. In 1965, less than 10 years later, he took over as CEO of Berkshire Hathaway. Buffett sticks to the value investing philosophy of Benjamin Graham. Value investors search for stocks with unreasonably low prices relative to their inherent value. Although there isn't a single, widely accepted method for figuring out intrinsic value, it's typically determined by looking at a company's fundamentals. The value investor, like bargain hunters, looks for companies that are undervalued by the market or that have a value that isn't widely understood by other buyers. Buffett elevates the value-oriented investing strategy. Many value investors reject the idea of an efficient market, EMH. According to this hypothesis, stocks always trade at their fair value, which makes it more difficult for investors to buy cheap equities or sell them at overpriced prices. They do believe that eventually the market will begin to reward those high-quality stocks that were temporarily undervalued. Buffett, though, seems unconcerned with the stock market's complex supply and demand dynamics. In actuality, he isn't interested in the stock market's operations. He rephrased the famous Benjamin Graham quotation in the short run: "A market is a voting machine, but in the long run, it is a weighing machine." He considers each firm as a whole, so he only selects stocks based on the potential of the company as a whole. Buffett holds these equities as a long-term investment because he prefers to own high-quality businesses with a strong track record of creating profits. Rather than pursuing financial gains, Buffett doesn't worry about whether the market will eventually recognize a company's value when it invests. He is worried about the business viability of such an organization. Buffett's methodology. When assessing the correlation between a stock's level of excellence and its price, Warren Buffett looks for low-priced value by asking himself a few questions. Remember that this is only a brief overview of what he looks for in his 7-step investment method. These are not the only things he considers. Company performance. The term stockholders' return on investment, ROI, is occasionally used to refer to return on equity, ROE. It reveals the rate of return on investment for shareholders to determine whether a company has regularly outperformed other businesses in the same sector. Buffett always looks at ROE, and it's not enough. Just look at the ROE from the past year for historical performance analysis. The investor should look at the ROE over the previous 5 to 10 years. Company debt. Another important factor that Buffett carefully evaluates is the debt-to-equity ratio, DOE. Buffett prefers to see a small amount of debt because it ensures that owner's equity, rather than borrowed funds, is used to produce earnings growth. The greater the ratio, the more debt is being used to finance the company's operations, rather than equity. This ratio demonstrates the company's equity and debt to finance its assets. Earnings can be unstable, and interest costs can be high if there is a high debt-to-equity ratio. Profit margin. In order for a company to be profitable, its profit margin must both be healthy and steadily growing. Net income is divided by net sales to arrive at this margin. Investors should look at historical profit margins going back at least 5 years. A high profit margin shows that the company is running its operations consideration by Buffett. The majority of technology companies that have gone public in the last 10 years wouldn't therefore appear on Buffett's radar. He explained that he doesn't comprehend the workings of many of the modern technological companies and only invests in businesses that he completely comprehends. Finding companies that have endured the test of time but are now undervalued is necessary for value investing. The importance of past results should never be underestimated. It's vital to keep in mind that public corporations are required to publish regular financial statements with the Securities and Exchange Commission, SEC. You can use these documents to examine crucial firm information, such as recent and historical performance, and then use that information to make critical investment decisions. Commodity reliance. Buffett believes that this is crucial. He avoids businesses that produce identical goods to those of rivals and those that depend primarily on a commodity like oil and gas. But he doesn't always do this. Buffett finds little that distinguishes the company from other businesses operating in the same industry if it does not offer anything unique. A corporation's economic moat or competitive advantage is any feature that is challenging to imitate. It is more difficult for a competition to obtain market share the broader the moat is. Costs how much? Finding businesses that fit the other 5 requirements is one thing, but the most challenging aspect of value investing is figuring out whether they are undervalued. And Buffett's greatest talent is this. An investor must ascertain a company's intrinsic worth by scrutinizing various business metrics, such as earnings, revenues, and assets, to verify this. Intangibles like the value of a brand name, which isn't expressly included in the financial accounts, are excluded from the liquidation value. Buffett compares the company's intrinsic value as a whole to its market capitalization, which is its complete worth or value. It seems simple, doesn't it? But we do not know how he developed such a fine grasp of value estimation. Warren Buffett consistently accumulated wealth over many years, mostly through investing. He began investing when he was just 11 years old, to be exact. As an adult, he established his own business and started making money by investing in businesses that he thought were undervalued. His riches would increase as he continued to reinvest his revenues into further ventures. He ultimately acquired Berkshire Hathaway, continuing his value investing approach there. Buffett's approach to investing is similar to that of a bargain hunter when it comes to shopping. It exhibits a realistic, practical mindset. Buffett also carries on with this mentality in other aspects of his life. For example, he doesn't own a massive home or collection of vehicles, nor does he ride in a limo to work. Although there are critics of the value investing approach, whether you agree with Buffett or not, the results speak for themselves. It's not professional financial advice, but purely based on our own research and opinion. So, do let us know which topic we should cover next. If you enjoyed the content, give us a like, and please subscribe to know more. See you at the next one. Bye.